Most people carry a very specific mental image of venture capital. For the hardcore ex-bankers and PE investors, VC seems like a relaxed buy-side job where you're in meetings all day and have big picture conversations. For others, it feels opaque and intense, like a constant arms race to get into the right deals before other top investors, with pressure to always be early and right and never miss the next big thing.
So with some proper funding, we should be able to get a functioning beta in time for CES. And if you don't fund us, you're a fucking slut.
After speaking with my friend at one of the top VC firms in the world, I learned that the reality actually sits somewhere in between, and it's also much quieter and more mentally demanding than what most people typically think. The slow days can be calm, but require deep work and research, while the busy days with live deals can mean everything becomes urgent at once. By the end of this video, you'll have a clear picture of what VCs actually do based on my friend's experience. And what we'll do is first go through her role for some context, and then dive into a normal, chill, steady state day, and then contrast that with a super busy day when she's in live execution mode. Now, before getting started, if you're interested in a career in finance and eventually breaking into private equity, you'll want to check out the PE Investing Certificate program being offered by Wall Street Prep and Wharton. This program is sponsored by top firms like Blackstone, Carlyle, and KKR, and over 8 weeks, you can learn at your own pace through this online course that's taught by Wharton professors, Wall Street Prep's PE program director, and real PE investors, including David Rubenstein, the founder of Carlyle, and Martin Brand, the head of North America Private Equity at Blackstone, who will cover topics like the PE deal process, valuation, how to think like a private equity professional, and more. By completing the program, you also unlock access to the alumni member database, fireside chats with PE investors, and exclusive networking events with the world's top private equity recruiters. This program runs 3 times a year, and be sure to use my code rareliquid to get up to $500 off, and I'll leave information for everything discussed in this video's description. All right, with that said, you need some context into my friend's role and firm, because a day in the life is very different for VC investors depending on the stage of the business lifecycle at which they invest. My friend is an investor at one of the largest venture capital firms in the world with roughly 20 billion in assets under management. And within that platform, there's a fund around $4 billion in size that she sits closer to. Check sizes range from 5 to 10 million to hundreds of millions of dollars depending on stage and conviction. She focuses primarily on Series B through pre-IPO, and specifically on growth, which matters a lot because growth stage venture investing has more data, clear markets, and real competitive landscapes from which you're really trying to pick the winner. So you're investing in a real business rather than purely a vision like you do when you're angel or seed investing. This also means that instead of spraying and praying and writing tons of checks, the number of new deals per year is pretty small. In growth venture, she works on 2 to 3 net new investments a year, while the rest of her time is spent supporting existing investments. On that note, across the year, her job breaks down into 3 big buckets. 35% of her time is spent sourcing companies and potential investments. 45% is actual deal execution, which can move quite fast. And the remainder 20% is portfolio support, maintenance, and operations of existing portcos. All right, with that said, let's start off with a normal steady state day for a VC investor. The day starts off around 9 a.m. with an hour-long call with a founder who's planning to raise in 6 months. And so she'll log the interaction in Salesforce or Affinity and set a reminder to make sure she remembers to follow up in a few months. And a lot of VC is simply about being organized and striking when the moment arrives. Then from 10 to 12 p.m., there's free time to read, research, and explore a space to build conviction in. This might involve reading market maps, scanning news, looking at who is funding what, and building a list of companies to reach out to. This is also where the job feels very independent because you're filling in your own calendar. And when you're not actively executing a deal, sourcing is a huge part of what creates value. Around 12, she'll grab lunch with a founder, and these meals are a lot more casual than most people assume. Sometimes it's a founder you're trying to get to know over time, or it's a founder you've already met and you want to just stay close to. And sometimes it's just a conversation to learn what they're seeing in the market. Then at 1 p.m. is a board meeting, and board cadence matters in venture. There are periods where board meetings cluster, often once a quarter, and those weeks feel busier even if there's no live deal because you're preparing for meetings, reading materials in advance, and deciding on what questions to ask. Board meetings last a few hours. This one lasts until 4 p.m. Usually they involve a small group of 5 or so people. And as a senior associate, you're a board observer, which means being present and engaged and prepared, but not dominating the conversation and just asking a few questions to learn about how to support the founder and help move the business forward. On these normal chiller days, if there isn't a board meeting, the afternoon might be more sourcing, outreach, clearing out your inbox, and taking calls. And so after doing some prep work for tomorrow, the workday ends around 5 p.m. And at this point, you can either just go back home, gym, and chill, or grab dinner with other VCs or founders. But ultimately, the normal days are quite relaxed and can feel like a 9 to 5 type job, even though you're on the buy side. Let's now go into a busy day, which is probably what you're most curious about. The busiest days as a VC investor is when a company you've been tracking enters a live fundraise, and suddenly you're in deal execution mode. The pace really increases because there's a timeline, there are competing firms, and founders are running a streamlined process, and you have to do enough diligence to make a decision with large financial implications within a few weeks. And so the day starts a bit earlier at 8:30 because there is a lot to do. And first order of business are expert and customer calls for 2 hours back to back to diligence the product. This is one of the most important parts of growth diligence because by Series B, the product has real users, the market is real, and customers can tell you what's working, what's missing, and how they evaluate alternatives. These calls aren't about getting people to say nice things and instead can be quite the opposite. You want to hear about the red flags and listen for the same themes repeating across different people, especially around switching costs, ROI, and whether the product feels like a core part of their system or more like a tool that could be replaced next quarter if budgets tighten. Then the next few hours from 10:30 to 1:30 is for deep financial diligence in the data room because growth ventures still requires a real underwriting mindset. Financial modeling in VC is a lot lighter than in private equity or hedge funds, but you still need to have a strong grasp of numbers in order to validate historical growth, dig into retention across cohorts, understand sales efficiency, calculate cash burn, and build a strong view of the operating model that provides a coherent multi-year picture, because without numbers, your conviction is just often based on storytelling and vibes. This is actually why a lot of VC firms hire investment bankers. And as a quick plug, if you are trying to break into banking and want personalized help for recruiting, feel free to check out my mentorship program, the Banking Accelerator. We'll leave information in this video's description. Back to the financial diligence. At this stage, return discipline also matters a lot because at the end of the day, that's what makes or breaks VC investors. The rough hurdle for growth investing is 3 to 5x, and your model is basically your way of testing whether there is a plausible path to that outcome without relying on magical thinking. Around 1:30, after a quick late lunch until 3:30, it's time to get a lot of things on the list done. First is synthesizing outputs for the model for the investment memo, then drafting slides for an internal check-in, and then preparing questions for a meeting with the founder to push on specific points. Deal execution mode is always frantic and busy because venture deal teams are extremely lean. A live deal might be a partner plus one senior associate who's doing most of the execution work and diligence without anyone to delegate to. That's why the day involves constant context switching because you're rotating between market, financials, product, people, and more without a buffer. From 3:30 to 6:30, 3 hours are spent on market work, which for growth investing looks different than early stage investing. Early stage can involve guessing whether a market exists because competitors might not be clear and customer behavior might not be consistent. At growth investing, the competitors are well known and the diligence becomes about understanding the competitive landscape deeply and deciding whether or not you believe the company you want to invest in is going to be the winner. You need to have your own view of the total addressable market and also how the market is segmented, how budgets flow, how buyers make decisions, and what your company's wedge actually is. Around 6:30 is a quick dinner, and then until 11:30 is the last stretch of the night that often turns into investment memo work because at some point you need to synthesize everything into a clear recommendation that your partners and ultimately investment committee can read and debate. This work involves tightening the narrative, incorporating learnings from diligence, articulating risks honestly from insights based on customer and expert calls, and presenting the returns analyses based on the financials. Busy days in venture during deal execution mode end around 11 p.m. or midnight, but these are not the norm across the year and only occur during sprints, which happen a couple weeks at a time, and even then, it's not midnight every night. And so that's what a realistic day in the life of a growth stage venture investor looks like when you strip away all the stereotypes. Most days are steady, independent, and learning heavy, and they can end at a normal hour, but you're still thinking constantly because staying sharp is part of the job. Then, a few times a year when a deal goes live, the pace compresses into 2 or 3 week sprints where you're doing market work, diligence, modeling, product evaluation, and founder diligence all at once. And you're moving fast and it can feel like contained chaos. The VC role is built around judgment, curiosity, and long-term thinking. And if you like learning and meeting impressive people, it can be one of the most intellectually stimulating careers out there in finance. As a last note, in case you're interested in breaking into VC one day, you may know that banking is one of the best training grounds for the industry. And so if you want personalized help for banking recruiting, check out my mentorship program, The Banking Accelerator. You'll get one-on-one coaching, weekly group calls with me, an interview bank with over 500 real questions asked, over 30 Excel exercises for technical prep, a daily finance newsletter, and an active community with 24/7 chat support. If you're interested, book a free call with my team using the link in the description or by scanning the QR code on the screen you see here. With that, thanks so much as always for watching and hope to catch you in the next video.